Hey everyone, welcome to the Small Cap Discoveries conference call. Today on our call, we have the CEO, Jim Rakievich from McCoy Global to give us an overview on the company. McCoy Global trades on the Toronto Stock Exchange under the symbol MCB. It also trades on the OTC under MCCRF. The company is currently trading at $1.25 with about 28.5 million shares, or about a $36 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks a lot, Trevor. Really appreciate Jim joining us today. McCoy Global, an oil service, energy services. I think we'll get into all the different things you do, but very topical right now. It's a name that we've talked a lot about in our forums and in our other discussions, and I know a lot of our subscribers are shareholders, so really appreciate the time you're taking to join us today and to give us a presentation, which of course we see the screen with the presentation ready to go. So Jim, I'm going to hand it over to you.
Well, thanks a lot, Paul, and really appreciate the invitation from both you and Trevor, and happy to spend some time this afternoon with you and your audience. So as an introduction to McCoy Global, we are a Edmonton-based, Canadian-based, publicly traded company, obviously, and our operations, for the most part, are based out of the United States, both in Louisiana and Texas. And internationally, we have a Eastern Hemisphere hub based out of Jebel Ali, which is the tax-free zone just outside of Dubai. And that team looks after all of our Eastern Hemisphere. I'll get into that as part of the presentation. Just quickly, I put up the slide that talks about our financial snapshot, and as we talk about internally here, you know, we've been flying under the radar for some time, but one thing we've always prided ourselves in McCoy is our maintenance of a very stellar balance sheet. And as you can tell by our balance sheet, as of the disclosures we put out on Friday morning with our Q4 and year-end results, subsequent to the year-end, we paid off the little debt we had. We're sitting in a strong net cash position, no debt. We have the best backlog since 2014, and we're very excited about the coming quarters and years, with not only the tailwinds of the market behind us, but also in particular, what we'll talk about is our technology roadmap that we've been executing on for the last 3 years. And we are at a more exciting stage of that development and getting into the market adoption phase. And we'll talk more about that as well. So introduction, as I described, we're located, we operate globally. We ship product on the average to 50 countries a year. Anywhere that they're drilling for oil and gas, we have an opportunity to participate, both land and offshore. As I described in Dubai, it's if you look at the chart where we're generating our revenue, it is a critical part of our business, the Eastern Hemisphere. So in our Dubai hub, we have a distribution warehouse. We have technical support for our customers in the entire Eastern Hemisphere. And we have a rental fleet of equipment that we deploy in that market, and also distribute new technologies and products to our customers. We have a sales and marketing group that looks after all of that, those regions. And it is the hot area for us and has been for some time. We've been operating out of that region, particularly the Middle East, North Africa, for well over 20 years. So we have a very large installed base with our customers. And as you'll see in future slides, that installed base is an important part of our sustainable revenue stream that comes off of aftermarket, and we'll talk about that. And so we're actually more of a technology and equipment provider to our customers. We do provide technical support and service, but we don't run casing. Our customers do that, and our job is to provide them with the best, safest, most efficient technologies, whether it's data acquisition or hardware, to do their job efficiently. We have some wonderful customers around the world, both on the land and offshore applications. Just to make it clear to the audience, what is tubular running services? Every well, whether it's horizontal, vertical, whether it's whatever hydrocarbon that well is being drilled for, gas, oil, or any other liquid, whether it's offshore or land application, every well is cased with steel pipes that are screwed together. And if you did a cross section of a well that's in production, all of that pipe will look like a telescope. You can start at the surface with 31-inch diameter tubular, and by the time they get to the pay zone, many tens of thousands of meters away, you'll end up with a production tubular that's maybe only 3.5-inch in diameter. All of that casing is cemented in the well, and the integrity of the well bore is dependent on every threaded connection that's made in that casing, that it's done correctly, safely, and it's got the integrity to not leak. So our primary customer base are service companies that run casing for a living. They'll either get hired by the drilling contractor, but more often by the E&P company. We also sell to and provide services to drilling contractors. There are times, both land and offshore, where drilling contractors in specific regions will run their own casing. And then our third customer base is thread manufacturers like Tenaris and BAM, and other OEMs like HMH, who was previously known out of Norway as MH Worth, and National Oil Well Varco. So those companies like HMH and NOV, particularly when it comes to offshore application, we stand alone in providing some of the most robust, large, high torque equipment that have to be integrated into the automated rig packages for offshore rigs. And we have not only the expertise, but the engineering horsepower to be able to complete those types of large projects with our customers. Tubular running services, I described it. Here's a schematic cross-section of what it could look like. And yes, every well has 40-foot lengths of pipe that are all screwed together for miles underground and cemented in. And our job is to provide the technology so that, again, our customers can do that job efficiently, and we provide not only mechanical equipment, but real-time data acquisition technologies as well. So we're ideally positioned. These are the 3 points that are really important for the audience is, what's changed? Why are we growing? Why is McCoy, what makes us stand out from the crowd with our competitors is, first of all, our international presence and footprint, like I described before, gives us a very strong advantage in the market. In the Middle East in particular, we're seeing a lot of national oil companies that are looking for independence from the large, Western service companies, and they want to start providing their own services. People like ADNOC out of the United Arab Emirates, 5 years ago, they never had any rigs. They would hire drilling contractors and service companies and expertise to come do all that work. They have over 100 rigs now of their own, and they announced not that long ago they're starting to enter into the tubular running service business themselves. So in the Middle East and North Africa, national oil companies want to have more control over the full value chain from exploration to production of their resources in their respective countries, and we're well situated to be able to participate and take advantage. And one of the most important aspects of why is it, besides us being there and having a great brand and installed base, in one of the slides coming up, you'll see that we have competitors in each individual technology. But when it comes to being able to provide the whole package of the group of technologies required to have a casing running package to be able to complete the jobs, we have the full integrated packages. We can provide those customers and with all of what they need to complete a contract. So that those customers much prefer to be able to buy all of their equipment and technologies from at a one-stop shop, and not only that, but have us in the local region providing technical support and training. The next trend that's important is the lack of reliable and skilled labor, and this is driving increased demand for automation in the casing running business and every other aspect of the oil and gas industry. I think it's probably well known by everybody in this audience that access to labor in not only the oil and gas industry, but many other markets is becoming more difficult to find, particularly since COVID. And in our industry, a lot of people retired during that period of time that had a lot of expertise, and attracting the next generation of casing hands and drilling crews and roughnecks, they're just getting so much harder to find, and nobody wants to do that kind of work anymore. So the biggest complaint we heard from customers over the last 5 to 8 years is the biggest challenge they have consistently is getting worse, is recruiting, training, and retaining people. And in the casing running business in the US and the Permian Basin, for example, 60% of the cost of running casing is labor. So we embarked on a journey that we'll talk about to help our customers by reducing the headcount of the requirement for casing crews by automating a lot of these technologies and developing an integrated tubular running package that uses sensors and smart technologies and takes away many of the requirements for not only the headcount and the people, but also the expertise that traditionally they would use experience to make decisions. And so they're looking for more data-driven, to my third point, decision-making technologies, rather than having some expert who's got a lot of experience decide whether it's a good connection or a bad connection. We've believed for some time that software should be making those decisions, and we're getting close to that sweet spot soon. Just a quick overview of what we've been doing since we embarked on the journey to go after that 1 billion annual labor cost savings globally, both land and offshores. We acquired a company from Pason Systems in 2017 called 3PS, based out of Cedar Park, Texas, which is a suburb of Austin. And their expertise in that business is collecting data in harsh environments. They not only, this was a critical acquisition at the right time, because we knew we were going to embark on automating a lot of the processes for casing running, which is a procedure we knew tremendously well and have a lot of deep knowledge about. But the 3PS folks, their expertise is how to get that data and how do you turn that into software and start to create machine learning software, etc. So they also at that time were a competitor of ours in one of our technologies, our torque sub technology. And so the way it turned out, it was a great acquisition. We took out our main competitor in one of our product lines. But what was most important to our plans over the future in our tech roadmap was that we needed some different expertise to add on to our mechanical engineering expertise. And that was the electrical guys, the sensor bit. We didn't have that in-house. And so that core competency became part of McCoy at that point. And then after that, we needed to address how we were going to get a casing running tool technology into the organization. In order to automate this process, we needed to move from our core product line at the time, which is hydraulic power tongs, a mechanical tool, to the latest generation of new technology for running casing off the top drive of a rig, and that's called a casing running tool. This is a mechanical internal tool that goes inside the casing, grips it, and turns it. And we had tried prior to that to work around the two companies that were in the market around the IP, and we were struggling. And but we were very fortunate in 2019. One of the two players who had good IP and an early entrant in a product into the market, but was a small company called Drawworks out of Bowling, Texas. We were able to acquire that business from the owner, and that was another key milestone to completing our tech roadmap. And then after that, we launched what we call our virtual thread rep, first digital product to be able to do all of the torque turn monitoring, the data acquisition. So we do two things with this product. That we monitor the makeup of the threads as it goes on live. And then second thing is our software takes over the final makeup so that a human can't make the error and not over torque or under torque the connection. Our software makes the decision when to stop the tool from turning and make the connection in exactly the specified torque that the OEM of the pipe insists on. So now with a virtual thread rep, we are able to do that remotely. Historically, the most expensive person on a casing crew was the person that ran that tool, and that person was on every crew and a lot of decision making and had the most experience. Now our customers can run 3 or 4 jobs from an office remotely, and all of these this digital product you can manage that remotely. And then if you need somebody like Tenaris, the thread rep, to make a decision, even if that individual is not sure and wants the OEM to look at the connection graph, they can log in off their phone from Starbucks and look at it and talk about it, have a chat on the software, and away they go. And then in 2022, last year was a pretty important year, is taking all that effort and design and development time that we did over that period of time and through COVID, and start to get through the field trial process of the individual technologies of the equipment that we've made smart. And then we start to receive our first orders late in the year. And so 2023, what's the big deal in 2023? Well, we're working on market adoption for our current commercial products. And then we have a project in the US where we're putting together the fully integrated package that's fully automated. And we're working with a partner customer out of Pennsylvania. And by the end of this year, everything going right, we expect to have the first fully automated, smart, integrated casing running technology running pipe in the US. And so 2023 is adoption year, and we're pretty excited about it. Those first 3 or 4 years of development are hard, but this is where we get to have fun now. So as I described, we do have competitors in various individual product lines, some with a few more products than others, but we have the full suite of products that we can do a complete package with. I'll give you an example. We had a customer a year and a half ago, Turkish Petroleum. They always outsourced all of their casing running to a company called Weatherford, and they decided they got their own rigs now for offshore Turkey, and this is the national oil company. And they decided to run their own casing, and they came to McCoy, and we were able to put the complete package together. And today they're running casing. We train them, and they have all our equipment, and it's pretty exciting because now we have a customer for a long period of time. And as they grow, we'll help them. Breaking away from our competition with smart technologies, I won't spend the time reading all the lines to you, but increased data-driven decision making. I've already talked quite a bit about that and what the value proposition is. Reliable automation and digitization of casing running, that has to happen. And they need, from a safety perspective, wellbore integrity, and the absolute labor savings is just the opportunity is just too big to ignore. And then the lack of reliable and skilled labor, I've talked about that already. So what do we sell in a little better closer look at our product lines and then what's our biggest product lines and where do we make the most money. So parts, accessories, dies, and inserts. It's a significant part of our revenue. And why is this important? You recall I kept reverting back to the phrase installed base. When you sell large packages and we have the installed base with many clients in the Middle East, Eastern Hemisphere, US, wherever we have clients in the world, this equipment gets used, it gets abused, it's in the field, they need replacement parts, they need maintenance parts, they need dies and inserts and service. They need our service. Sometimes they send our stuff to us to get refurbished. So parts and accessories and dies and inserts, we call that our aftermarket. It's a critical, and that's a repetitive revenue stream. For every dollar of revenue that we sell, you can imagine we're going to get 40 cents of aftermarket. That's how high it's represented, and it's higher margin. I always like to compare the old Johnny Cash song. If you build a Cadillac one piece at a time, it costs you a fortune. It's kind of the same with the piece of equipment that we sell. If you buy all the individual parts, you wouldn't be able to afford the tool. But the aftermarket business is a good business for us, and it's got really good margin. Hydraulic power tongs was our core business, and same with breakout units and bucking units. But that technology there's a lot of competitors, and it's hard to differentiate yourself. There's not a lot of IP in that space anymore, so it's a competitive market. So we do sell it. It's part of our offering. It's part of the packages that people need. They can't do everything with the casing running tool, but it is a competitive market. Sales and rental. Our rental business has increased significantly over the last 5 years. 6, 8, 10 years ago, nobody rented this kind of equipment in this industry. They always wanted to own it. And now it's the market's changed. The capital allocation that our customers are making decisions on often do not include purchasing everything for a single contract. So we entered into the rental business, both for our data acquisition technologies and our capital equipment. And I'm happy to say we've been growing it year over year. We are a bit conservative. We like to have good paybacks on our rental fleet, and it's done quite well. So we're pretty happy with where the trend, not only on the growth of our rental business and service business, but also on the contribution margin from those endeavors. Casing running tools and handling tools. It's a small but growing. Remember, we acquired that business when it was a very small business that had that casing running tool technology, but we've been gaining market share year over year. And I'm happy to say, when you look at our backlog that we have today, casing running tools is now a very key part of that. I'm looking forward to updating our percentage of revenue in 2023 when the year ends. And I think you'll see that number quite a bit stronger. And of course, the margins are better. And then data acquisition and sensors. I don't want to miss the fact that we do, on a previous slide, we have a brief description of our sensor business. 3PS, when we acquired it, they do have a sensor business and that was the birth of their company, was providing data in harsh environments. And we still have that sensor business. It's small, but very profitable. So we sell into the aerospace industry, nuclear, military, and construction, cranes, for example. So we have customers in those markets that are a traditional part of 3PS's business. So recent initiatives crystallize the value of the company's real estate. We made an announcement just before Christmas that we did a sale and leaseback. When we acquired 3PS from Payson, it included the land and buildings, and the real estate market improved significantly from the time we acquired 3PS to when we sold the land and buildings last year. So we made a sizable gain that we announced on the sale and leaseback, and so we're pretty happy with that to monetize that. we're not in the real estate business. We would rather monetize that, take the gain while it's available, and then we signed a 5-year lease, not a long-term lease, and with an option to renew. And we're going to be able to deploy that capital, hopefully in areas that can give us a nice return. And we introduced a return on capital target as a component management incentive plan. Alex Riskov, who's on the call, he's one of our directors and also chair of our newly formed capital allocation and strategy committee with our board of directors. And so Alex and I work closely together, and he works with our team and our view of the world going forward. And will continue to be is where can we deploy the shareholders' capital and get the absolute best return, and because we've got to do better than our cost of capital. And that will help us position the company to achieve double-digit returns on invested capital through the cycle. And of course, the real strategic priority this year, as I've described a few times, is to achieve the successful commercialization and adoption. To me, this year's adoption of the smart technologies. And that is my last slide.
That's perfect.
I hope I didn't get too carried away there.
No. That was perfect. I appreciate it. We didn't sort of talk about addressable market. Like, give us a sense. I mean, it sounds like you cover a couple of different areas within drilling and services. But how can we define the market that you're really after in terms of dollars?
So the total market, we showed you the labor piece, but obviously now that the market is improved, the size of the tubular running service business has increased. So globally, if you wanted to put an estimate on what's the global tubular running service market right now, it's probably $2.5 billion a year, maybe $3 billion now. And that's both offshore and land. So that includes the revenue that the tubular running service companies are generating, and all of the people that provide technologies and services and things like we do. So that total market is that size. When it comes to what's the addressable market for McCoy, it's probably like immediate addressable market. If we got 100% of the bucking units and the tongs and the CRTs and the technologies, it's well over $500 million.
That's fantastic. And how do you the way I view this is that there's a lot of innovative technology that you're applying to, I almost call it a cyclical industry. So it's not, to some degree, you're at the mercy of the cycle, but there's new adoption, you're likely taking market share away from sort of standard practices. Is that the right way to look at this?
It is. So if you think about our project that I described in Pennsylvania, you've got the entire U.S. land market, say arguably 750 rigs today active. The rig counts, kind of drive how much casing's being run. Mm-hmm. So right now, nobody has a integrated casing running package to deal with all this labor issues and all that cost. So we believe that once we are able to prove the efficiency and the cost savings to that market, I don't think unless you have that integrated package, I don't know how you're going to be able to compete. And so we'll have to build that. We'll have to build that portfolio of packages in that market to accommodate the growth and the adoption. Mm-hmm. But we think the opportunity is substantial, assuming everything works exactly how we expect it to work, that we can provide the efficiency that we expect to provide, and that the customers are going to be able to recognize the savings in labor costs. They'll be able to be who has that will be the most competitive, and we'll be able to take away the market share from everybody doing it the traditional way.
Mm-hmm.
And
The way I've got it,
we'll happily replace their kit.
yeah. The way I've sort of got it in my mind is that if the industry slows down, there's sort of the demand for cost savings everywhere. But if it speeds up, there's the demand for labor that you guys sort of solve. So you kind of win a little bit no matter what happens within the industry. Is that correct?
Absolutely.
Yeah, perfect. Okay, let's talk about your financials a little bit. I mean, you had a record year, really strong end to the year here. You know, what drove it? You sort of explained what drove it, but sort of what happens next? You guys are sitting on a fair bit of cash. You know, obviously your capital allocation expert that's with us is going to determine that somewhat, but what, you know, sort of give us an idea of what a company like yours does with cash. What do you do next?
So we look at, you know, there's various buckets we can deploy capital. So the first thing we look at is our business, and, you know, where can we deploy capital to grow and improve and make our business better and improve shareholder value and generate more revenue, more margin, all that kind of stuff. So, you know, one of the ways we looked at, you know, strong deployment of capital 3 or 4 years ago was our technology roadmap. I would say to you and the audience is that the largest bulk of our capital required for the tech roadmap development has been deployed. So, you know, we're on the tail end of that now. So we don't need our balance sheet to fund the tech roadmap to the finish line. Some, but it's pretty much, you know, we can handle that through cash flow. So the other area that we can certainly deploy capital into the business is by looking for tuck-in or other acquisitions. You know, we've built McCoy and this part of our business, this core business, on both organic growth and acquisitions. So, you know, oddly enough, we did 2 acquisitions during the last downturn. They were both strategic, but the timing was really good from a valuation perspective. And so we're fortunate to still have the balance sheet. And so part of what Alex is doing, working closely with me, is we're looking for those opportunities to deploy capital and add value to the business and see if we can do some growth in that manner. So then after that, if we can't find homes or we have excess cash above deploying it in the business organically or through strategic acquisitions, we certainly believe our stock is undervalued. So another area that we can deploy is share buybacks. So we're happy to do that. And then the other area is that we would look at is dividends. You know, at some point you can't sit on cash forever.
Cash is good, but you know, sometimes it's nice to get some back to shareholders. I agree.
Yeah. I would say, Alex, those are the 4 buckets.
Is Alex gonna chime in here?
Yeah, no, I think Jim covered it. I will just point out that in our press release, we did state that we're planning on introducing, you know, on the ballot at the next AGM, a provision to reduce our stated capital that would allow us to pay a regular dividend. And so, you know, we wouldn't have done that if we didn't think that we would be able to do all of the sort of above, if you want, in terms of looking for organic growth, potentially looking at acquisitions that meet our return hurdle, and also begin returning capital to shareholders.
Mm-hmm. Okay, fantastic. You know what, Jim, we talked a little bit about the industry outlook before we went live. Maybe let's talk a little bit about, clearly there's uncertainty. There's always uncertainty, I guess, in this industry, but you know, oil prices off their high. There's, you know, global issues, there's banking issues now, there's all sorts of things. But from the inside, from an industry insider, what can you tell us outsiders, your sort of expected outlook, you know, the industry in general, and then a little bit more specific to maybe the trends you're seeing for your business?
It's a great question, and there's some specifics, both regionally and and buy commodities. So because we have a global perspective and we operate and sell to customers around the world, I would say that we're pretty convinced that the supply of hydrocarbons, in spite of the trend to have decarbonize the world, the demand is just over 100 million barrels a day as we sit here. And what we've experienced, particularly internationally and in places like the Middle East, in spite of the additional capital that's being deployed, and that is committed capital, the ability to maintain production at the levels historically is becoming much more difficult. So much more drilling and activity towards exploration is going to have to continue. Offshore is another great example. We're starting to see a resurgence. Transocean's got the biggest backlog since 2014 as well. And one of the reasons is there's been almost nothing done in offshore during the downturn. Mm-hmm. It is big capital gambles, but you got to build reserves, and some of the biggest reserves in the world is generally deep water offshore. So we're starting to see an uptick there, and we don't expect, in spite of all of the noise around recession and all of this, banks and interest rates. If we've had such a lag in capital being deployed in this market for a while now, and it's going to have to, somebody's going to have to keep turning the bit in order to just maintain the levels of production that the globe needs. So China's come out of all of their COVID restrictions, so they're going to start consuming more and more and more. And we saw what happened in Europe with the conflict with Russia and Ukraine. And the United States, they were the swing producer, and that's gone back, I think, to the Middle East. And so in the US, the capital, what's different? One of the questions is what's different from the last swings turns. And one of the things that's big, there's two things to me that are very different. One of them is interest rates. Mm-hmm. So that has a big impact on deploying capital because you can't get it. And then the second is the discipline on capital allocation that the E&P companies, particularly in the US, mm-hmm. have been displaying. So the shareholders won't put up with another 10-year run and then come out of the end with nothing. So the percentage of capital that's generated that gets returned to shareholders is much bigger than it used to be. And that discipline, it looks like it's holding no matter what. So I think those differences suggest that for us at McCoy and for others, our activity level is going to at least maintain itself. And we feel pretty confident with that. And then with our new technologies and our global footprint, we're well positioned to weather the storm. And we're fortunate, we've historically, if you look back, we've been a bit conservative because of, we have cycles in this business. You can get caught. So we've generally always wanted to be prepared for when the cycle turns the other way. And in many cases, we've been able to take advantage of that because of our balance sheet and do some strategic acquisitions like we did and still invest in organic growth like we did.
Mm-hmm. And Jimmy, you mentioned a whole bunch of challenges sort of facing the industry. Let's talk specifically about your company. What challenges do you guys face, or more or less what keeps you up at night?
Right now, well, we had our board meeting on Thursday, and I think I spent most of my time when I talked about what's keeping me awake at night, and it's still supply chain. Mm-hmm. So we need to produce this stuff and have better lead times than our competitors and all that kind of things. And the supply chain is not fixed yet. Mm-hmm. We use in a lot of the equipment that us and our competitors sell, we don't use just standard iron or metal or steel. there's exotic steels, there's forgings, there's, our components are made from a variety of raw material, and it's been challenging. Our competitors are having the same issue, but getting lead times down, and it's not because we can't, assemble the stuff and test it and ship it. The shipping challenge, the logistics, by the way, has gotten a hell of a lot better than a year ago. So we're able to get containers, and we're able to air freight stuff, and we're able to costs for freight have come down a bit, but it's the supply chain has been, because the reason it makes your hair gray is because a lot of the supply chain issues, they're weekly battles, and some of them come without warning. Oh, by the way, what I was going to ship you next week, it's going to be another 6 weeks, so then it screws everything up. But I would say that's what keeps me awake at night. But we got a great team behind it, and it's a bit of still firefighting.
Right, gotcha. I'll take this minute here just to remind everybody, if you got questions that you'd like me to ask Jim, just use the chat function, and I'll do my best to ask the question. Okay, let's switch over a little bit to the stock side of things. 28.5 million shares outstanding. Let's talk about the makeup of the shareholder base right now. Insider ownership, what sort of percentage is owned by insiders?
Roughly about 10%.
10%. Okay. And the balance, where do you think it's a small micro cap company right now. Do you have institutional following, or is there any strategic owners, or anything you can tell us about the balance of the ownership?
Yeah, our next management information circular will be out in April, but if you even look at last year's, and then our new largest shareholder did a filing recently. So Canal Capital out of Wyoming is our largest shareholder now at 16.2%. But Canal's been in the story for several years, and has now recently grown that position from about 12.5%. We have 3 other large institutional shareholders that have been in the story for various lengths, but all of them for 3 years plus. That's 2 Canadian companies, 2 Canadian institutions in the US. They're in our MSC. Fidelity out of Boston, still at 12.5%, 13%. And we've got Burgundy Asset Management, who's down to about 13.3%. And then Ewing Morris is they're rated in that 13-ish% as well. So those 4 hold a big chunk of McCoy.
Yeah, it starts to add up really quickly. Jim, now I don't recall, are you the founder of the company, or did you come in after the fact?
I hope not, because the company was formed in 1914.
Oh my goodness, okay. Far too young.
I've aged well.
Maybe your great grandparent or something. Yeah.
No, it's an interesting story. I'll just quickly tell you. In 1914, Henry McCoy opened up a blacksmith shop in Edmonton, Alberta. And that's, it's a true story. And the 3rd generation, they were always in industrial, and being in Alberta, a lot of oil patch related products and springs and trailers, but a lot of related to oil patch. But the 3rd generation McCoys, brothers, 2 brothers, the company was called McCoy Brothers, sold the company in 1995 to a small private equity group out of Edmonton. And then they IPO'd it in 1996.
1996, okay.
Became CEO in 2002.
2002, I gotcha. Perfect. Excellent. Well, I got a couple questions that came in, so I'm going to fire these off and see how you answer them here. So one question is related to the cost savings. Approximately how much cost savings can your clients expect using your integrated package? How do you frame that?
Well, I like to be a bit conservative. So if you consider whatever the dollar value is of a contract in the US, and I said that we know that now from the data from our customers is that, and 55-60% of that cost is labor. We don't think we can eliminate 100% of that labor, but we can eliminate probably 75% of it.
Wow. Okay. Okay. So significant.
Yeah.
Yeah.
So instead of 8 or 9 guys on the casing crew, we should be able to get it down to 2, maybe 3.
Wow. Okay. Wow. That's a lot more significant than I thought. That's impressive. And the other question from the same individual here, exit strategy. How do you position this company for the future? Are you looking at some point selling it, or is this going to be around for another 100 years plus?
Well, none of us know the answer to that. We did, it's public. We went through a process just over a year ago.
Right. Yeah.
Not a lot was happening on the M&A side, and it was unsuccessful. But in this industry, the M&A consolidation and M&A activity compared to pre-2014 and prior, where there was always a lot of activity, it was like quiet, and there was not a lot of consolidation. And I think last year was a good example where the market started to turn, but all of those that would be consolidators or acquirers, the strategic guys in particular, they were 100% focused on reducing debt, cleaning up their balance sheet as the market was getting better, but they had some work to do. To clean up their balance sheets, focus on debt reduction, focus on share buybacks, and getting, all of us had laid off a lot of people and reduced costs. And so most companies were much more focused on that. And I think there was, people were still gun shy, and the market at this time last year, we weren't sure we were going to be where we are today. We had no idea it was going to be if you'd asked me this time last year, are you going to have the best backlog in 12 months from now, like you had in 2014? I'd have said, I don't know. But now we know. So I think we're seeing more activity on the M&A side and a little bit more on the consolidation. So look, we're a small micro cap, but we do very well. We've got very excellent products, great team, and we're for sale every day. I like to say.
That's a good way of saying it. Absolutely.
Yeah. And whether somebody decides over the next 2-3 years that McCoy's a good acquisition target, well, whatever happens, we don't have control over that. So there's no definitive finish line to this thing. Our job as my job as CEO, and the job of our management team, is to run the best company and do everything we can to increase shareholder value. And whatever happens outside of that, it'll happen.
Exactly. Perfect answer. Okay, a couple more things before we wrap up. Just as investors watching from the outside, what sort of think are the key metrics or maybe even catalysts that we should be watching out for to really determine how well you guys are, on track?
Right. Well, I think when you look at, I don't think that the audience should be too concerned about our ability to generate revenue. Sometimes, when you're in the business of actually producing products and shipping, quarter to quarter, that can be lumpy sometimes, but just look at our backlog. And my metric to, are they sustaining and growing their backlog? That's important, because that's our future, right? And so backlog's important metric for us. And the other thing is watch for the news on our technology roadmap and our milestones.
Perfect. And then lastly, Jim, is there anything we haven't covered that we should have talked about, or barring that, a key takeaway, something you want to make sure everybody walks away with today?
Well, I think one of the things I'm always proud of, and I don't even know if I mentioned it much, but in the market that we're in, we have a very well understood and acknowledged in the industry core competency. So when we look at our competitors, if you look at our engineering resources and our deep knowledge of the actual application of what we do, the application knowledge of casing running is something that we have a lot of expertise in this organization. So, and then when you look at what we went through since 2015 and then the COVID time, what I'm really proud of is all of our core team, our critical core team of people in this organization. They're still here. And so I always believe that investing in companies that have strong and very competent and capable teams that stick with it, that's a big deal. They'll find a way to make it happen. The success of the company for them, they take it personally.
Yeah. No, it always comes down to good people.
Yeah.
How that always works. Well, listen, this has been fantastic. I hope everybody's gotten out of it as much as I have today. Jim, I want to thank you. We've been speaking with CEO Jim Rakievich, McCoy Global, and Alex joined us as well, a member of the board. Thank you, Alex. Symbol MCB on the TSX. I think we certainly want to keep up to date, and hopefully we can catch you back in the not too distant future.
Yeah.
Thank you.
Appreciate the time.
You got it.